Hello there, and welcome to another edition of Analyst Insights. We hope you had a fantastic week. Here we go again, talking about all things market, investment, business, and economics. So there's so many issues that we're going to dwell on this episode this week. But before we get into that, let me introduce my colleague Rufaro. Welcome, Rufaro, to Analyst Insights.
Thank you for having me, Ranga.
Thank you. So I think the issue that we need to discuss to start off with is we saw this week a report saying our consumption of fuel actually went up from 1 billion liters in 2020 to about 1.2 billion liters in 2021. Maybe the question that one would ask is, what do you make of that vis-a-vis activity that we are seeing on the market and also recent results? I think for this week we're going to review the results of Econet and also of AFDIS. That consumption, is it in line with what we are seeing in terms of economic performance, and or maybe something different?
Yeah, so if you look at the trading update from AFDIS and Econet, which where they saw significant volume growth, and you marry that to your question, it speaks to economic growth coming from a low base in 2020, where there was economic contraction, where we had long periods of hard lockdown in response to COVID. We did have some lockdowns in last year, but they were not as severe. So so coming off the low base in 2020, we had much more economic activity, and this is what is reflected in the higher fuel consumption and the better volumes being experienced by AFDIS and Econet. So really the question going into this year is, can we maintain that momentum, or are other things going to derail it?
Yeah, so talking about other things that could potentially derail the growth for this year, maybe one can talk about the expected outturn for the agricultural sector. So certainly last year was a good year for the sector, with a big crop actually being achieved. Obviously, there are still some debates as to the actual number that actually achieved, but I think what's clear is that it was a fantastic year. So already we are seeing reports that the crop, the area under crop for this year is about 2.4 million hectares, and generally the condition of the crop is good. So when you look at that number, maybe in terms of vis-a-vis the projection, we were expecting to put around 3 million hectares under crop. We are on 2.4. I think last year we certainly did more. That's why we were projecting 2.7 million hectares. Sorry, 2.7 million metric tons. What do you expect in terms of how that is going to pan out, given that there are quite a number of agro-based businesses even on our local base?
So I think this year is not going to be as productive as last year for a number of reasons. To begin with, the 2.4 million hectares is slightly less than last year's hectarage. And then unlike last year where we had a fantastic rainy season, this year the rains came through a little bit late. And what we're seeing now in terms of the heavy rainfall is actually not completely positive. This level of heavy rain is associated with leaching, where the soil loses some of its nutrients and fertilizer. So the outlook for this year's agricultural season is not as bright as last year's. In fact, we will likely produce less, and the question really is how much less. If you think about it in the context of the agricultural sector and the listed agro stocks, then basically the outlook for this year is going to be lower volumes and lower sales and earnings than what we experienced in 2020.
Yeah, and perhaps you can talk about another headwind that we were dealing with in 2021, which was the power shortages. So this week there is a story that says Kariba South Power Station is expected to resume full capacity. How would you react to that kind of news, and how confident and excited can you be given the power shortages that we've experienced in the past few years, if I could put it that way?
So it's definitely a positive development. Hydro is not only a renewable source of energy, it's also the cheapest source that we have in our country. It's certainly cheaper than thermal coal and solar. So it's a positive development. It will definitely make a contribution to the grid and ease some of the outages that we've been seeing. But fundamentally, we don't have a well-run power utility that has a monopoly on power. So I don't think it's going to change things. It's going to change the landscape meaningfully. Well, I think outages and power challenges are going to be with us, although perhaps to a lesser extent because we have more output coming out of Kariba. So I think the message or strategy for the business community is to make a plan to continue to invest in Plan B, where they become more self-reliant and independent of the utility. This will obviously increase the cost of doing business, but perhaps it's a lower cost than lost production. So that's just par for the course in terms of our macroeconomic environment, and I think everybody in business understands this.
So there you have it. So it's positive, but we need to still brace for more difficult times ahead. And as a business, it's best that you make plans to get alternative energy if the grid disappoints, as it always does in the past few years. Perhaps another macro issue that we need to look at before we jump straight into the markets is issues to do with the foreign exchange, especially the rate. So this week we saw the RBZ telling us that they had a fruitful meeting with business leaders, and I think on the top of the agenda was stabilization of the exchange rate and making sure that the foreign currency resources that we're generating is able to service everyone. And I just want to get your response and your reaction to that meeting, and also the objective, which is to try and stabilize the rate. And maybe when you're answering that, to try and put it into proper context, the fact that we have generated just under 10 billion foreign currency from exports, from grants, from diaspora remittances. How do you make of the foreign exchange developments going forwards, given that that scenario? Do you think we are able to achieve this objective of stabilization? And do you think these kind of meetings are helpful?
So I think if you think about the idea of stabilizing the currency, and you look at last year, you pointed out that we had almost $10 billion in hard currency receipts, which is quite impressive. So in the context of that, we still managed to fail to achieve price stability. You can choose whichever metric works best for you, whether it's official inflation at 60% per annum, or the official rate, which also moved significantly last year, or the power market rate, whichever yardstick you want to use to measure the stability of the currency. I think that we can agree without controversy that we failed to achieve stability. In the context of that failure, I think it's encouraging that the Reserve Bank is engaging with market participants, and hopefully they take the feedback they get seriously, and perhaps pivot in terms of exchange rate policy in a manner that engenders the stability that they speak of. Because certainly, if we continue within the same policy framework that existed throughout last year, we're going to see more a continuation of price instability and instability of the local currency. So it's a positive development. The question, it remains to be seen whether it leads to changes and policy actions that actually lead to better outcomes. So I think, certainly engagement is better than not engaging, but we'll have to wait and see how well it works.
Yes, so obviously the other biggest issue has been COVID in the last 2 years. And this week, there's a report that the National University of Science and Technology is working on rolling out production of PCR test kits with actually a view to reduce the cost to about $20 per unit. What would be, how do you react to that kind of news vis-a-vis the fact that the COVID issues that are still around us, and the general outlook that maybe this will be here for some time?
Yeah, look, I think the reality that we all need to accept is that COVID is not going away. It's going to be with us forever. I don't think Omicron is the last variant. I think there are other variants that are in our future. And how well we do economically is a function of how well we manage living with the virus. And so developments where we are able to produce test kits locally and cheaper are positive, because it just basically improves our capacity to manage whatever the virus throws at us going forward. So I think I look at it as a net positive. I think we need to continue to make investments in that space to make our defenses more robust, because it's not going to go away. I think the best case scenario is one in which we move from thinking about COVID as a pandemic to thinking about it as endemic and coping. So I think it's a step in the right direction, and we hope to see more investments in that space.
So maybe just to conclude, we look at market developments in particular. I just want to get a comment from you on the issue of the accessibility of our markets to retail investors. So there is an argument that we've actually made some strides backwards, because some 10, 15 years ago, we had unit trusts. Remember the days of Making Money Makes Sense, Kingdom, and there was the likes of Barbican, etc., which really made some strides to try and get everybody on board, even before the financial inclusion issue really became such a big story. When you look at the market right now, do you think it has got enough structures to accommodate retail investors? And what needs to be done for the retail investor to be more accommodated? So when you look at even their participation in the last few years, what could you say were the major driving forces behind that?
So I think, look, access has definitely improved. I think the latest product is the ZSE Direct product, which was launched recently by the local bourse. I think before that, you had the FinSec, the other exchange, coming up with a product which allowed people to buy small amounts of shares using feature phones. I think it was a USSD-based product. So I think accessibility on the back of improved technology has improved a lot. But I don't think that's what's driving the increased retail engagement that we're seeing on the ZSE. I think that's coming from the fact that we live in a hyperinflationary environment, and most people understand that Zim dollar bank balances, unless they're deployed, are going to lose value over time. So, and they're becoming alive to the ZSE as a market that can ring fence their savings from the vagaries of inflation. So I think that's what's driving it. I think we saw this happen before, between 2006 and 2009, where you had massive retail engagement on the ZSE, because the retail investor understood that keeping a Zim dollar bank balance, was a sure way to lose value. So I think that's where, so the levels of hyperinflation are not as bad as that period, but I think the thinking is the same, that Zim dollar bank balances are a liability. So the moment you have a bit of excess local currency, it makes sense to invest it, whether it's in currency, in groceries, or on the ZSE via these new technology channels.
Thanks so much, Rufaro, for those insights. That is all that we had for this week, and we hope that you'll have a pleasant investing week. And we want to hear your comments, your feedback. Please remember to like our Facebook page, subscribe to our YouTube channel on ZFN Capital, and also engage us on Twitter on ZFN Capital. Otherwise, bye-bye for now.